So how can we use CVP analysis to analyze changes in the business environment? CVP analysis can be used to perform sensitivity analysis, a method of determining what would happen if variables such as the sales price, variable costs, fixed costs, or the sales mix changes. As always, the easiest way to demonstrate the use of CVP analysis in a changing business environment is to use an example. We'll use David Inc., a company which manufactures XD2. The company currently sells 2,000 units per month. The following information is available for the month of November. Selling price per unit, $1,100. We then have all of the following per unit variable costs: direct materials of $400, direct labor of $200, sales commission of $30, and administrative expenses of $100. The total variable cost per unit is therefore equal to $730 per unit. Next are listed the monthly fixed costs as follows: manufacturing overhead of $86,000, sales costs of $21,500, and administrative costs of $322,500. Total monthly fixed costs are $430,000. First, let's assume that David Inc. is considering offering a 10% discount on the sales price of their product. What effect will a 10% discount on the sales price have on the break-even point for this product? First, the new sales price would be equal to $1,100 multiplied by 90%, which is equal to $990. We used 90% because 100% minus the 10% discount is equal to 90%. With this new lower sales price, how many units would David Inc. have to sell in order to break even? We'll use the contribution margin approach to calculate this. The formula for this approach is as follows. Q, meaning quantity in units, is equal to the total fixed costs plus operating income divided by the contribution margin per unit. So we need an updated contribution margin per unit. This is calculated as sales revenue per unit of $990 minus total unit variable costs of $730, which is equal to $260. Monthly fixed costs are equal to $430,000. Going back to the formula to calculate the break-even point, Q equals total fixed costs of $430,000 plus operating income of $0, because we're calculating break-even here, all divided by $260, the new contribution margin per unit. Q is equal to 1,653.846 unit, which we can round up to 1,654 units. With the original sales revenue per unit of $1,100, the break-even point was 1,163 units. With the new lower price of $990 per unit, the break-even point has increased to 1,654 units. The higher break-even point means that we have to sell more just to break even, an additional 491 units more. The lower sales price means that each unit sold contributes less to covering the fixed costs, so we have to sell more units in order to cover those fixed costs and break even, which means the company will be less profitable. We definitely don't want to offer a 10% discount. Let's now assume that David Inc.'s management would like to consider another alternative. Assume that David Inc. would like production to become more efficient. They plan to install new equipment which will increase the fixed manufacturing costs by 30%. However, they feel that the new equipment will decrease the direct labor costs by 40%. Question: should they install the new equipment? We can use CVP analysis to determine the answer, using the contribution margin approach again. First, the fixed costs were $430,000, but with a 30% increase in fixed costs, the new fixed costs will be $430,000 multiplied by 130%, which is equal to $559,000. This would cause the direct labor costs, which are $200 per unit, to decrease by 40%. So $200 multiplied by 100% minus 40%, which is 60%, is equal to $120 per unit. Using this, we can now calculate the updated total variable costs. Direct materials of $400, new direct labor of $120, sales commission of $30, and administrative expenses of $100. The total variable cost per unit is therefore equal to $650. We need the contribution margin per unit, so $1,100 of sales revenue less the updated variable cost per unit of $650 is equal to a contribution margin of $450 per unit. We can now apply the formula to calculate the break-even point, which is Q equals fixed costs plus operating income, all divided by the contribution margin per unit. Using the updated information from David Inc., Q equals total fixed costs of $559,000 plus operating income of $0, because it's the break-even point, all divided by $450, the new contribution margin per unit. Q is equal to 1,242.222 units, which we round up to 1,243 units. With the original total fixed costs of $430,000 and direct labor costs of $200 per unit, the break-even point was 1,163 units. With the new higher fixed cost of $559,000 and the new lower direct labor cost per unit of $120, the break-even point has increased to 1,243 units. We will have to sell an additional 80 units just to break even. We should definitely tell management that we shouldn't install the new equipment since the higher fixed costs are not offset by the lower direct labor costs. In fact, the company will be less profitable if they move forward with the purchase. Let's do one final example. A supplier for David Inc. is increasing their prices and, as a consequence, direct material costs will increase by $25 per unit. In order to maintain the same selling price, the company plans to cut fixed manufacturing overhead costs by $38,000. Currently, the company sells 2,000 units and earns an income before income taxes of $310,000. Management would like to know if the number of units sold would have to increase in order for the company to maintain their current income before income taxes of $310,000. This is a question of target income before income taxes. Before we do any calculations, we have to determine the new costs. Direct material costs will increase by $25, so direct materials will increase from $400 per unit to $425 per unit. Total variable cost per unit will now equal $425 plus $200 plus $30 plus $100, which equals $755 per unit. We also need the contribution margin per unit, which is the sales revenue per unit of $1,100 less the updated variable cost per unit of $755 for a contribution margin per unit of $345. Finally, we also have to calculate the new fixed costs. Since fixed costs will decrease, we take $430,000, subtract that $38,000 savings, and that will equal $392,000. We now have all the updated information we need to apply the contribution margin approach. The formula for this approach is as follows. Q, meaning quantity in units, is equal to the total fixed costs plus the target operating income divided by the contribution margin per unit. Q equals total fixed costs of $392,000 plus the target operating income of $310,000, all divided by $345, the contribution margin per unit. Q is equal to 2,034.783 units, which we round to 2,035 units. This means the company will have to increase the units sold from 2,000 units to 2,035 units. That's in order to earn the same operating income before income taxes of $310,000. There's really not much the company can do since the supplier will be increasing the price, but with CVP analysis, the company will at least know exactly what they need to do moving forward. You can see that CVP analysis can be used to determine many different what-if scenarios, which allows management to make better decisions about the future. As always, thank you so much for watching.